So I'd love to chat about what is a trigger rate, what is a trigger point in people's mortgage, and how is that impacting people right now from what you're seeing?
The trigger point is when your payment isn't enough to cover the interest on your mortgage. So that's just the simple way you can think about it.
I was personally shocked. I do have a property, an investment property on variable rate, and I was looking at the spread between how much my payments stayed the same, but I was looking at the spread of how much my payments changed from what they were paying for principal versus interest a year ago versus now. And it shocked me. I haven't quite hit that trigger point, but I think that's something that a lot of people don't understand or haven't paid attention to.
For anybody that's in a variable rate mortgage, depending when you got it, or regardless of when you got it, it's not fun. You know, I think for Adina's place, it was before COVID that you got that mortgage. So it all, with variable rate mortgages, really it's about when you start your mortgage. So what are the interest rates when you start it? Because that sets up the payment plan for the next 25, 30 years, depending what you're looking at. So, you know, just to keep it simple, when Adina got her place, Prime was here, and then COVID hit and Prime went down there, and now Prime's up here. So 3 different buckets that we can kind of look at in terms of when you got your mortgage. So if we focus on, because it was a very busy time, the COVID low interest rates. So let's say when people were paying the 1.3%. So let's put some numbers on it. There's 2 types of variable rate mortgages. One where your payment will adjust if interest rate change, and the other one that's more static. Majority of banks, so probably a majority of people watching this, have a static payment, which will eventually hit the trigger point. If I think of my clients that got a mortgage at the interest rate lows, about 80% of their payment went to principal.
Wow.
20% went to interest. Yeah, that's a great ratio for a mortgage, especially at the start. However, with the interest rates going up, you know, for them effectively tripling, the payment that they have isn't enough to cover the interest that is accruing.
So now it's 100% interest and still not enough to cover the
Exactly, so you need to increase your payment basically. So, you know, to put some numbers on it, so if you had a mortgage of about $600,000, and let's say you got that at the low point of the interest rate cycle, so around 1.3, 1.45%, your mortgage payment would be set up at about $2,000, so about $2,005. If you're with that lender where the payments adjust because interest rates have gone up, your payment would have gone up about $1,100. So from $2,000 to north of $3,100.
That's like a 50% increase.
Yeah, it's pretty huge. So again, you're going from like trough to peak in terms of that scenario. If your payments were static, so they keep the payments the same, but they change how much goes to principal and how much goes to interest, then you would be looking at, again, you'd start at $2,000 and your payment wouldn't change. But if you looked at your bank statement today, the amount that you would need to pay in interest every month to cover that mortgage is $2,400.
Wow.
So your payment's $2,000.
Wow.
But the interest accruing every month is $2,400.
So you're not paying any principal, you're short $400 on interest. So that's when the bank is coming to you and saying you need to increase your payments by at least $400.
Exactly.
And what if someone can't? Is that an option?
Yeah, there's a few things you can do, like you can look at refinancing options. I would say there's limited options because most of the people that got into that situation right now are now forced into that position. They got the mortgage within the last 2 years and they probably set up their mortgage over the maximum amortization. So life of the mortgage, which is 30 years.
Right.
So maybe there's a little bit of relief there, but really the main move you have is to increase your payments.
So this scenario, we've heard it from a few clients whose payments have gone up or the bank has come to them now because they've hit their trigger point. I'm curious how often you're seeing it right now amongst your clients. How common is this?
Yeah, we're certainly having lots of conversations with our clients in terms of the percent of mortgages that we have for our clients that are variable rate. It's between 30 and 40%. So it's a large chunk of our clients as well. We're talking about options, the prepayment options, or the things you could do to help with that trigger point to see if that's the right move for them. The inevitable question is, should I lock in? Yeah, there's no blanket answer for that. The general statement is that we think the worst has happened now, and fixed rates have shot up as well. So you've lived through the worst of it. So certainly don't lock in for 5 years, maybe 1 or 2 years.
What's the difference right now? So if someone's on this variable rate and they're at the trigger point, what's the spread between variable and fixed right now? Because from what I've seen, you'd have to increase your payments to go fixed, no?
If you got your variable rate mortgage during, we'll just call it COVID, when interest rates were really low, you were getting discounts of prime -1, prime -1.1, 1.2, so very big discounts. So right now your effective rate's high 4s. If you have that. If you go to lock in, you're around 5.5% probably, just as a gauge, it's between 5.5 and 6. So someone who just got a variable rate mortgage, let's say 6 months ago, their discount has shrunk. So, it's prime -half, and new variable rate mortgages are prime -half. So right now fixed for 1, 2, 3, 4, 5 years are all roughly the same as a variable rate mortgage.
So it's equally painful, basically.
Yeah.
All it would protect you from is if there's future
there's no
interest rate
savings.
increases.
Yeah.